You've got a pile of cash in your hands. You're ready to buy some stock in this new internet company that everyone is talking about. It's going to change everything. But here's the part nobody tells you. By 2001 and early 2002, almost all those speculative companies would see their valuations plummet or disappear entirely. This is the story of the dot-com bubble and how the excitement of a new technology became an epic crash. Let's start with why it happened. In the late 90s, internet use was exploding. People thought online businesses could revolutionize everything. Companies went public without making a profit, just ideas and potential growth. Investors poured in. By 2000, dot-com startups raised over $100 billion through initial public offerings, IPOs, but here's what you need to know. Most of these companies were losing money hand over fist. They spent millions on advertising and office space, but generated little to no revenue with no clear path to profitability. Yet their stock prices skyrocketed based purely on speculation and hype, rather than solid business fundamentals. So how did this work? Companies would go public, often with sky-high valuations, even if they had not turned a profit yet. Investors bought stocks, hoping to sell them later at an even higher price. As the market became overinflated, more companies rushed in, contributing to the bubble's expansion. But here's where it gets tricky. When reality hit, it was brutal. By early 2001, dot-com companies started laying off workers and cutting back investments. The bubble burst, leading to a sharp decline in stock prices. Over $5 trillion in market value disappeared as investors pulled out of the tech-heavy Nasdaq index. Let's look at some numbers. In March 2000, the tech-heavy Nasdaq index hit an all-time high of over 5,000 points. By October 2002, it had dropped to under 1,100 points. That's more than 4/5 wiped out. Companies like Petscom went bankrupt after burning through millions in just a year. Now, why did this happen? Investors were chasing the next big thing without doing proper due diligence. They ignored warning signs such as unsustainable valuations and lack of revenue. The psychology was key. People thought they could time the market by buying early and selling at peak prices. But the bubble burst when it became clear that many of these companies had no substantial business model or revenue streams to support their high valuations. Let's break down one example. Webvan, an online grocery delivery service. They raised more than $800 million in the stock market between 1999 and early 2001, but went bankrupt by August 2001. Why? They invested heavily in building warehouses and distribution centers, but failed to develop a sustainable business model that would generate profits. Now let's talk about the human impact. People lost their jobs as companies collapsed, often taking employee savings with them. Even large investors faced significant losses. However, it's important to note that while some individuals and early investors made substantial profits before the bubble burst, many others suffered significant financial setbacks. Subject: the dot-com bubble burst, the rise and fall of internet startups. The lesson: don't get caught up in hype. Focus on fundamentals such as revenue, profit potential, and business model. This bubble serves as a cautionary tale about the dangers of investing based on excitement rather than substance. Now here's where it gets interesting. After 2001, investors were more cautious with tech companies for several years. However, a new wave of innovation emerged in the late 2000s with social media and mobile apps. Many learned from the dot-com era but still made similar mistakes. History tends to repeat itself if we forget its lessons. Let's recap what happened step by step. 1. Internet use surged dramatically. 2. Many internet-based companies went public with little to no profit. 3. Investors rushed in, driving up stock prices. 4. Reality set in as it became clear that many companies could not sustain their rapid growth or profitability. 5. The stock market experienced a significant downturn, resulting in substantial losses for investors. So why should you care? This is about understanding how markets can get ahead of themselves. It's a classic example of speculative investing leading to a crash. But here's the crucial part: not all internet companies failed. Some, like Amazon and eBay, survived and thrived by building solid business models over time, even though they faced significant challenges early on. Now let's look at the broader economic impact. The burst led to a recession in 2001. Unemployment rose and consumer spending fell. It took years for tech stocks to recover, but here's another counterintuitive point. Some investors who held on long-term eventually saw those same companies rebound and grow. Now let's circle back to the psychology of it all. People often seek quick wins and get excited by new ideas while missing red flags. This period highlights the importance of skepticism, especially during a booming market. Always ask, what happens when reality sets in? So here's your takeaway from this story: don't jump on hype. Do your homework, look at the numbers, and invest for the long term. The dot-com crash in the early 2000s is a reminder that every market boom can be followed by a bust. Now let's tie it all together. 1. Internet use exploded. 2. Dot-com companies went public without proving profitability. 3 investors fueled speculative growth through initial public offerings, IPOs. 4 reality set in as many companies could not sustain their losses. 5 the stock market experienced a significant downturn, wiping out hundreds of billions in wealth. But here's what you need to remember. Some savvy investors stayed in the market and witnessed significant gains in the years that followed. So while the dot-com crash was indeed devastating, it also marked a shift towards more disciplined investment practices. This is educational and historical, not financial advice. The dot-com bubble wasn't just about overvalued stocks. It was driven by unrealistic expectations and misplaced faith in technology's immediate impact on profits. Investors poured money into startups promising rapid growth, but lacking concrete business models or significant revenues beyond buzzwords like e-commerce or vague future technologies. These companies spent millions on advertising, hiring talented developers, and creating visually impressive websites, essentially betting heavily that merely being an internet company would ensure profitability. One famous example is Petscom, which went public in late 1999 with a valuation of around $54 million despite having no revenue at the time. The company burned through cash on TV commercials featuring sock puppets and never made a profit before going bankrupt less than a year later. Another casualty was Webvan, an online grocery delivery service that raised over $380 million but failed to deliver on its promise due to high operational costs and logistical challenges. By 2001, the tech-heavy Nasdaq index had lost more than 75% of its value from its peak in March 2000. Many investors found themselves holding stocks worth a fraction of their original investment. Companies that managed to survive did so by cutting costs, focusing on revenue generation, and implementing sound business practices rather than relying solely on market hype. Despite the wreckage, opportunities arose for patient investors. Post-crash, tech firms such as Amazon and Google strengthened their positions with robust fundamentals and sustainable business models. Those who purchased shares in these companies following their IPOs experienced significant long-term gains. The aftermath of the dot-com bubble burst led to a shift in how businesses and investors approach technology investments. The emphasis shifted from speculative ventures to companies that demonstrated real financial viability, sustainability, and scalability. This period marked the beginning of more disciplined tech investing, where thorough due diligence became paramount before funding any new venture. In short, while the dot-com crash of 2000 to 2001 was a painful lesson for many investors, it also served as a catalyst for better investment practices and business acumen in the technology sector. It taught us that just because something is innovative doesn't mean it'll be profitable without sound planning and execution. This is educational and historical, not financial advice. The dot-com bubble burst in 2000 forced entrepreneurs to focus on building sustainable businesses rather than chasing get-rich-quick schemes. Companies had to prove they could generate real revenue and profit, not just traffic or eyeballs. The era of build it and they'll come was over. One stark example is Petscom, which raised $82.5 million in its initial public offering IPO, but went bankrupt less than a year later due to unsustainable losses. This company's failure highlighted the dangers of pursuing rapid growth without a solid business model. Another cautionary tale is Webvan, an online grocery delivery service that burned through nearly $800 million before folding in 2001. This underscores the importance of addressing fundamental market needs and managing costs wisely to ensure long-term viability. The dot-com crash led to stricter regulatory oversight. Stock exchanges tightened listing requirements for technology companies, making it more difficult for speculative ventures to raise capital easily. This shift aimed to prevent another bubble by ensuring that companies met certain financial standards before going public. Moreover, the bursting of the dot-com bubble in 2000 accelerated the adoption of e-commerce among established businesses. Companies that had been skeptical about online sales quickly adapted as consumer buying habits shifted towards digital platforms. Traditional retailers recognized the need for an online presence to remain competitive in the evolving market. Ultimately, while many startups perished during the dot-com crash of 2000 to 2001, enduring tech giants like Amazon and Google emerged stronger. These companies survived because they focused on long-term value creation rather than short-term hype, demonstrating that sustainable growth is possible in the tech industry when backed by solid fundamentals and innovative execution. Subject: the dot-com bubble burst. The rise and fall of internet startups. In retrospect, the dot-com era was a necessary phase of trial and error that ultimately refined how we approach technology investments today. It taught us to distinguish between genuine innovation and speculative hype, leading to a more mature and resilient ecosystem for both startups and investors. This is educational and historical, not financial advice. The dot-com bubble burst in 2000 to 2001 exposed the flaws in many business models that relied solely on attracting eyeballs rather than generating revenue or profit. Investors learned that simply having a website was no guarantee of success. Companies like Webvan, an early online grocery delivery service, raised hundreds of millions but failed to deliver sustainable value. Another critical lesson emerged from the dot-com bubble: diversification is key when investing. During the late 1990s, many investors concentrated their portfolios in technology startups, often losing significant sums when the market crashed at the turn of the millennium. Spreading investments across various sectors and asset types can help mitigate risk associated with economic volatility or sector-specific downturns. The aftermath saw a shift towards more rigorous due diligence and valuation processes for tech companies seeking funding. Venture capitalists, VCs, began focusing on metrics such as customer lifetime value, revenue growth rates, and profitability, rather than relying solely on user numbers or website traffic volume. Ultimately, the dot-com crash of 2000 to 2001 was a watershed moment that forced the tech industry to mature from hype-driven speculation into a sector grounded in real business fundamentals and innovative practical applications. This period set the stage for the stable, sustainable growth we see today in leading tech companies. This is educational and historical, not financial advice.